Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 129 of our YouTube channel and podcast. And I could not be more excited to continue to share personal finance topics that I think can be useful for you in your long-term financial journey. Today is a special episode. Today, I know I told you guys I would talk about rules of investing that we need to follow and how to go about investing in that way based on those rules. But today, I decided to divert just a little bit, and we need to pay some attention to something that's going on in the stock market right now, and it's something that in my time investing I have not seen, at least at this scale, and I think it is worth talking about, so stay tuned to learn more about what's going on right now and how this may affect you. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes day after day. And then if you need somebody to help you with a financial plan, creating a financial plan, staying accountable to a financial plan, and working through it with you, then I can do that for you. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that will work best for you, and we can begin pushing towards your long-term financial goals together. So what is so urgent and so interesting that I divert from my schedule of shows? What is so interesting that I think that we really need to spend a whole episode talking about it? Well, it is what's going on in the stock market right now in a few stocks. A few different stocks have exploded in the past few days specifically. And the reasoning for this explosion is multifaceted, but the basics of that explosion are what we call a short squeeze. And this has really impacted companies like AMC, right? AMC, has a lot of the movie theaters and things of the like. And then GameStop, which, sells video games, gaming consoles, things of the like. Those are two of the biggest names that have been impacted. But other companies like Bed Bath & Beyond have also been impacted in this particular way. And I want to talk about why this happens, what is happening in the market right now, and how we can as long-term investors, how we can view what's going on and whether or not we should get involved in any kind of way. And so I'll just start today by explaining to you what a short sell is. Okay? When you are short selling, right, because this is a short squeeze. Well, something that goes on in the market is called short selling. And what happens within a short sell is that you benefit from the price of a stock going down, or the price of whatever you are short selling going down. And so what happens is the trader, the individual, will borrow stock from a broker, right? So whatever broker you're using, you will borrow shares of stock in whatever you want to short, whatever you believe is going to go down in value. So you will borrow those shares and immediately sell them on the open market. So you borrow them, immediately sell them, so you have money in your pocket. And then what you hope for is for the price to fall. And then what you would have to do as a short seller when you think the price has fallen all that you want it to fall, and you are making a good profit. The way you make that profit is you repurchase at a lower price and give those shares back to your broker. And so basically what you do, instead of the whole idea of, when you invest, buy low and sell high, well, what you're doing, you're just doing it backwards. You are selling high and then buying back low. And so the profit that you make is the difference between those two values. And so a lot of investors, especially institutional investors, and something that I'm really going to key in on today is hedge funds, right? Hedge funds who try to do a lot of shorting of stocks and hedging their positions by shorting certain companies. They try to make money in this way. They try to make money by companies going down in value. Now, there is an issue with this ideology. There's an issue with trying to short something. And the issue is that if that thing continues upward in value, then you can lose potentially a lot of money as a short seller. The losses on being a short seller are unlimited because there is unlimited upside to a particular stock that you have out there. And you have to put, when you are short selling, you have to have a certain amount of what they call margin. And this margin is money that's saying, hey, if the stock is to go up in value, can you cover? Can you still pay that broker back for the shares and the value of the shares that you're going to have to buy back later on in order to cover your short position? And the problem for a lot of people and individuals, if a stock has a big run up, they have a problem with covering their shorts if the stock is to go up too high, so they will cover relatively quickly. And so that is how you would make money and or lose money in short selling. And obviously, when you're short selling, you can only make up to 100%, and actually, less than 100%, obviously, because you do have to cover your short position. But you can only make up to 100% because the stock can only fall 100% from the place at which you sold it initially. But it can rise in an unlimited amount over time. And so it can be dangerous to short sell. And I wouldn't recommend it for any of you guys. I just want you to understand what it is. That way we can get to talking about this specific idea of a short squeeze. When a short squeeze occurs, then what ends up happening is a bunch of people or a bunch of institutions, just a bunch of investors are purchasing a particular stock, and the price of that stock is rising and rising and rising. Well, as I just said a moment ago, if the price of a stock is rising, then whoever is shorting that particular stock is losing money. They are losing value in their holdings. And so it is going to push those shorts to cover their positions, to not continue to short that stock. Well, what does that do? If you are buying up, right, if you are purchasing the stock to increase the price, so the price is rising, well, then the shorts have to cover if they can't continue on with their positions or justify continuing with their positions, and they decide to go ahead and cover. Well, when they cover, what are they doing? They are purchasing the shares again. Like I said, the way that you end a short sell, because you sell at the beginning and then you buy later, hopefully at a lower price, but here they're buying at the higher price and then having to use their margin that they put up to cover the rest of the loss that they have. And so what this does is it continues to push the stock higher, because not only is the stock being bought by investors, it is being bought by the short sellers who are covering their position. And this is what's known as a short squeeze. The squeeze is investors purchasing the stock because it's putting a squeeze on the individuals or the investors that are shorting the particular stock. It's squeezing them and saying, hey, it's getting harder and harder for you to justify keeping this, and you're going to take more and more losses. And so the shorts, they end up covering, and the price continues to rise, and those who bought it will benefit and will profit. So what's the issue? What's the problem here? What is going on that is so interesting in a particular short squeeze that is occurring as of right now? Well, there are many stocks that are heavily shorted. And GameStop was one of the most heavily shorted stocks in the United States stock market. And so what has happened, and it's so interesting about what has happened and how it has occurred, is that these individuals online, on Reddit, of all places, right? We've all heard of Reddit, either been on Reddit, whatever it may be. And these individuals on Reddit, on a subreddit called WallStreetBets, right, have been talking about these particular companies that are heavily shorted, and they have been kind of pooling together to go in and purchase a lot of shares in these companies that are heavily shorted. Because what is that going to force those shorts to do? It is going to force those shorts to cover their positions. It's going to force those shorts to end up losing money on their short positions. And then those who have bought the stock will continue to gain in their position. And why is that? Because the shorts are covering. So not only are they buying and people are buying it up and pushing the price upward, then the shorts have to push the price upward as well. And so this is something that on such a wide scale I've not seen. And it's showing up, like I said, in GameStop stock, in the stock of AMC, And these are just two of the big examples. And I'll just give you an idea of the impact of these particular short squeezes over the past couple of days. And so if you look out 5 days ago, GameStop was trading on the opening of Thursday, January 21st. And that's 5 trading days, obviously. They were trading for $39.23 a share. Okay? Well, as of right now, the current market price is $347.51. So they went from $39.23 all the way up to $347.51. That is a huge rise in 5 trading days and makes no sense based on fundamentals. Because this is not a fundamental trade. This is shorts being squeezed out of their positions in GameStop. And GameStop had over 100% of their stock being shorted, which is almost unheard of. And so the gain for somebody who would have bought GameStop 5 days ago, 5 trading days ago, would have been 785%. So the stock has risen 785% in 5 trading days, which is just mind-blowing, right? Well, then there's also AMC, and we know that AMC has struggled, especially during the pandemic, because movie theaters and things of the like, and entertainment in that way is not continuing in the way that it was. Well, it was selling for $3 a share 5 days ago. $3 a share. It is currently selling for $19.90. And so these numbers don't seem quite as big as those with GameStop because they had a higher share price to begin with. But it went from $3 to $19.90. And so if you would have bought it 5 days ago, your gain over that 5 days would be 563%, which again is just outrageous. It's mind-blowing. It doesn't make any sense based on the fundamentals of this company. And so what we see going on here is not investing. And I want to remind you guys of this. This is not investing. What this is pure speculation. And again, I want to remind you guys what I've talked about before about the definition of investing based on Graham and Dodd's security analysis back in 1934. But this is a groundbreaking work for investment analysis. And so they say that an investment operation is one which, upon thorough analysis, right? So these individuals who started this short squeeze may have done some analysis, so we'll give them that, okay? But upon thorough analysis, promises safety of principal and a satisfactory return. Now, buying in to one of these stocks because you see what's going on is not promising safety of principal. If anything, it is being extremely risky with your principal. It is not safety of principal, and you can very well lose your head in one of these stocks. So this satisfactory return part cannot be promised either. And so this is not an investment. Anything other than that is obviously speculation. It is gambling, right? We are just placing a bet on what is going to occur. A lot of the people who are purchasing these shares know nothing about these companies. Absolutely nothing. They don't know what's going on within the company. They don't know, if the company is doing well financially or not. They just know that they can make a quick buck. It is short-term thinking. Now, don't get me wrong. There are a lot of individuals who, over the past few days, have bought GameStop, have bought AMC stock, have bought Bed Bath & Beyond, all these different heavily shorted stocks, and have ended up making a lot of money. That does not mean that it is right. That does not mean that this is what you need to be doing in your portfolio. If anything, I would deter you from following the crowd in this way or following the herd in this way, especially this late in the game, this late in this anomaly occurring. You could really, really, really lose your head, because what is eventually going to happen, because yes, these short squeezes, what they typically look like are just, increases in share price that, are good increases, but they're not this crazy. These are just crazy increases in share price. But what will eventually happen, because we know that this is how stocks work. Stocks are based on fundamentals in the long term. Over the long term, these stocks will come back down to earth, and we are long-term investors. And we don't want to buy in to this idea of just making a short-term quick buck. And so this is not for us. These trades are not for us. We are not traders. We are investors. Okay, we are not speculators, we are investors. And the way that we invest in things is not for a day, a week, a month. We're investing for the long term, for many years to come. And so that's just my saying. This is not investing, so do not try to get on this train. I'm just saying that, yeah, even though people have made money, doesn't mean it's what you want to do. Because people have made a lot of money speculating in Bitcoin or speculating in gold or whatever it may be. Hey, somebody won the $1 billion lottery this past week. And so you see that people can gamble and make a lot of money. But that does not mean that you need to be gambling and trying to make money in that way with the short-term mindset, because that is not what investing is. And what this is really being pushed by, right, these individuals in this Wall Street Bets subreddit, what they are is mostly young people. It's mostly people who don't have a lot of experience with investing. They want to make money quickly. They do have a short-term mindset. And so they're just trying to jump on any trend that they can find. I mean, we've even seen this same type of thing occur with stocks like Tesla. Now, Tesla had some short squeezing as well, because any stock that goes up that quickly obviously will if they do have any shorts outstanding. But what was also going on within Tesla was just, hey, we're just going to buy. We don't care what the price is. We like Elon Musk. Elon Musk is on Twitter. This seems like an awesome company. They do awesome stuff. We like SpaceX. We like all these things that Elon's doing. So we're just going to buy Tesla, right? And we see Teslas. The cars are cool. We're going to buy Tesla, right? And that's what individuals have been doing. Again, speculation into stocks. What this causes is these overvalued companies. So the value of these companies has to, over time, come back down to earth, which can leave you hurting. And typically, if things go up fast, they can come down very, very quickly as well. So just, I would just shy away from it, but we need to learn from it. We need to learn how this market activity is occurring. So not only have we seen this short squeeze over the past few days, what we have also seen is crazy action in the options market. And I'm not going to give you a whole setup on what options are. I can do that at some other time. But what I'm going to tell you is just the quick definitions. Call options, right? If I say a call option, that is the right to buy a stock at a certain price. So if you buy a call option, it's cheap to buy options relative to buying the shares of the company. If I buy a call option, then I buy the right to purchase a company stock at a given price. Okay. And so there are in the money and out of the money options. And so an out of the money option would be something like this. The stock's currently trading for $100. I buy a $120 call option, which is saying I can buy the stock. I have the right to buy the stock at 120 by some particular date, right? And if the stock exceeds that 120, I can still purchase it for 120. And so that would be an out of the money call option, because when I purchase the call option, it is not worth much to me, because I would not want to exercise at 120 when I could have just bought the stock at 100. Now, similarly to these call options, there are also put options, which is just the other side of things, right? If call options are the right to buy a stock at a certain price, put options are the right to sell a stock at a certain price. And so if you own a stock and you just want some type of downside protection, let's say the stock is at 60, and you say, okay, I'll buy a 50 put, right, on this particular stock. Well, again, puts are cheaper than actually buying a share. Options are just cheaper than buying the shares. And so that is an out of the money put option, because why would you want to sell at 50 right now when you currently own the stock at 60 and you could sell at 60? So that is an out of the money put option. But once it goes past that price, then it is in the money. Same way with the call option. Once it increases with the call option past the particular strike price, is what they call it, whatever the price on the option is the strike price. And once it goes past that, then it is in the money. Now, why does this matter? Why is this important for what's going on with this particular short squeeze and with GameStop and AMC and companies of the like? Well, the reason that this is important is because options are really easy to buy nowadays. Okay, Robinhood and Webull and all these different types of online trading platforms make it very, very easy to purchase options, very cheap. Transaction costs are obviously at all-time lows, so it's easy to buy options. Well, options, again, come in call and put, right? And so if you take the market action specifically on Tuesday of this past week, right? GameStop closed at 147.98. And remember, I said their currently closes like 340 something. So, I mean, this is outrageous activity that we're seeing. At that moment, call options that let investors buy shares at 200, right? So these are out of the money call options, right? By Friday, we're trading for about $19 a share. Okay, so it would cost $19 to buy that option. Okay, this is a fraction of the cost of the actual share. And if you bought such an option and GameStop rallied, the price of your option would surge, obviously, because the closer you get to that strike price of that call option, the more valuable that option is, because the more likely it is going to end up being exercised. It's going to end up being, somebody will end up buying for that 200 price, even once the price goes above 200. Okay. And so if you owned actual GameStop shares, you would benefit from the rally too, but you likely wouldn't get as big of a return as you would with the calls, because again, the call only costs $19, whereas the price of the share was $147.98. And then the price of the call could just blow up based on how quickly the stock moves. Now, you could also use options to help reduce risk. So a lot of people, especially in GameStop, are pushing to buy put options because they own the stock. They end up buying the stock. Well, they want the downside protection. They want the right to sell at a certain price. And so people are buying these put options. Now, why is this contributing to the pushing of the price upward and upward and upward? So when I buy a call option, somebody has to sell it to me. And typically that is what's called a market maker. So this is an electronic trading firm that buys and sells stocks, options, or other assets throughout the day. And there are several different groups that do this type of thing. Now, market makers aren't in the business of placing long-term bets on company stock prices. So when such a firm sells you a GameStop call option, the market maker generally hedges that risk through a separate trade. Often what it will do is it will go ahead and buy these shares of GameStop to hedge that risk. Well, naturally, what occurs then? Well, if there's a lot of buying and call options and these market makers are having to write new call options all the time, well, then what are they constantly going to be doing? They're constantly going to be purchasing the shares of GameStop to hedge their position, which is going to do what? Which is going to continue to push the price of the shares upward. And even more so than that, as the price continues to rise on those call options and get closer to the particular strike price, right? The price at which you would be interested in exercising possibly, then market makers can step up their purchases to remain risk neutral in their position. So they may keep buying GameStop stock. So it doesn't make sense why they would do this, because when you own the stock, you benefit from the upside. But when you sell the call option, right, then you are still going to have to sell that stock to an individual or to an institution, whoever bought the call option, at the strike price. So if the price goes way above the strike price, then you lost a lot of value as the individual who wrote that call option. So owning the stock is a way in which you can hedge that position. And so obviously with options, if you can buy options that are cheap and get the upside potential, then people are going to continue to do this. And the option activity has been off the charts, and they've been selling these options within the day, which is very, very rare. But they've been selling them within the day and taking their profits multiple times throughout the day. And so this is just this big snowball effect of all of these different things, the short squeeze occurring, right? And so the shorts are being squeezed out, so they're having to purchase their shares, right? And individuals coming in real hard, purchasing shares, forcing those shorts out. And then individuals coming in buying options, which is forcing the market makers to buy shares to hedge their positions. So everything is just putting upward momentum pressure on the stock. But again, it has nothing to do with the fundamentals of the company. It has nothing to do with what the company is actually doing. All it has to do with is just the way that the market is set up and the way that investors can push short sellers out. And so what's really going on here on a wide scale is that retail investors, meaning you and me, right, the individuals, the little guy, are pushing against Wall Street, right? So individuals who work on Wall Street, work on hedge funds, do a lot of shorting of stocks, they are very upset at this moment, right? Because they may be doing something that is perfectly logical by shorting something based on the analysis that they've done if they think that that thing is going to go down in value. They may be doing something completely logical, but this movement in the stock is completely illogical. And so they might be forced out of their logical positions by people who don't know a lot about the stock just because it was causing losses that those individuals were buying up the stock. And again, like I said, over the long term, the price can come back down to earth and can come back down to the actual value that it is worth. But the problem is that in the short term, those individuals who are shorting, those hedge funds that are shorting, they are constantly having to put up more and more and more capital to maintain those short positions. And sometimes it is just not worth it to do so if you're taking such huge losses. Because again, the losses are, they are untethered. There's no stopping the losses if the price continues to rise. But you can only make up to 100% on your short. So you see this issue. You see this conflict in the investing world between the retail investors and the institutional investors. And right now, the retail investors are winning. But I wanted you guys to be aware of this. I wanted you to be aware of what was going on in the market, why you see companies like this shooting upward, why you should not get involved in companies like this shooting upward, and why there is a distinct issue that is occurring right now that I'm sure there's going to be much talk and much regulation about moving forward, where you can continue to push a stock higher and higher and higher and higher based on nothing that has to do with the stock's fundamentals. So again, as good investors, and we've talked about this week already, value investing, growth investing, as good investors, what you have to do with both of those types of strategies is you have to be very cognizant of how you value a company, how you look at the company's fundamentals, you look at their revenues, you look at their earnings, you look at their ability to grow in the future, you look at all of these things, what their industry is doing, their valuation metrics, all these types of things, and you can make a determination on whether or not you want to purchase something that is going to go up in value over time. But I don't condone necessarily you trying to short anything, because you see how dangerous of a game that can be. And I don't necessarily condone you trying to jump in with these individuals who are buying up these stocks or buying these call options or whatever they might be doing to try to make a quick buck. It is just so risky, and it is based on nothing. And we don't want to be speculators based on nothing. We want to be investors. We want to be long-term investors that make good decisions on what we are purchasing based on some fundamentals. And many of you don't need to be focusing on individual stocks at all, but you may be seeing these movements in the stock market and may want to get involved. Don't get involved. This is not for you. Okay, but we just need to be aware. We need to be aware when we see anomalies like this, when we see big things going on in the market, why they are occurring, what's going on, and if they have impacts on us. Again, these stocks aren't some of the biggest stocks on the stock market, and they're not having a huge impact on our market indexes. So if you own mutual funds, index funds, this is not having any kind of drag on your returns, or it's not having any kind of push up on your returns necessarily either. And so this is something that you need to be aware of, something that you need to understand, because when you do see a stock shoot upward, you need to know why. And this can be one big reason why. When you have short squeezes, when you have individuals coming in buying call options, you have market makers hedging their positions, all of these things play together to just make a frenzy of buying in these names that really there is nowhere close to the value that they appear to have in the market today. So thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to get back to you there. If you're listening on Apple or Spotify podcasts, then be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplementary materials to all the things I'm putting out in these long form episodes every single day on YouTube and the podcast. And then if you need somebody to help you with a financial plan, to create a financial plan that would work for you and keep you accountable to that plan over the long term, I can help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I get back on track and I talk about those rules of investing that we all need to follow. And so that'll be a really interesting episode. I think you should all tune in from, and you can all learn a little something along the way. Hopefully you're learning from all these episodes, but you can learn a little something along the way in tomorrow's episode. So thanks for tuning in to today's episode of Money's No Object. I'm your host, Dylan Howell. God bless.